US markets fall on tech valuation concerns. The Reserve Bank of New Zealand cuts and signals more to come. So the New Zealand dollar falls more than 1%. And Bank Indonesia also cuts to support growth. That's coming up in 5 Things in 5 Minutes on Thursday, August the 21st. And in our deep dive interview, ANZ New Zealand Chief Economist Sharon Zollner dissects the Reserve Bank of New Zealand's latest forecasts after a dovish cut.
We saw interest rates and the exchange rate both drop sharply, and that will translate immediately through the economy.
But first, in 5 and 5 with ANZ, US stock markets were again led lower overnight by big tech companies as a lack of key data ahead of Jackson Hole saw traders focus on valuation concerns. Meanwhile, over the Atlantic, UK inflation accelerated more than expected in July to 3.8% from a year ago. ANZ economist Bansi Madhavani says services inflation of 5% led the rise.
The inflation data are higher than Bank of England's own forecast just a few weeks ago. It is this stickiness that is holding them back from cutting rates in succession in an environment of otherwise weak activity and labour market. Our read of the data is that they support a gradual easing stance. Financial markets on their part remain quite apprehensive about the prospects of another rate cut this year. Only 12 basis points of easing is priced in for the remainder of the year.
As of 4 a.m. Sydney-Melbourne time, the S&P 500 was down 0.4% and the Nasdaq down 0.8%. The US 10-year Treasury yield was down 2.4 basis points to 4.275%. Gold up 1% to $3,390 US an ounce. West Texas oil futures up 1.4% at $63.25 US a barrel. The US dollar index was down 0.2%. The Aussie dollar down 0.25% at 64.40 US cents. And the Kiwi was down 1.1% at 58.34 US cents after yesterday's much more dovish than expected Reserve Bank decision. Number 2, the Reserve Bank of New Zealand cut its official cash rate by 25 basis points to 3% yesterday, as expected. ANZ New Zealand Chief Economist Sharon Zollner says it's now picking a lower OCR track.
So the Reserve Bank cut 25 basis points as anticipated, but it was the most dovish 25 basis point cut you can imagine. The details showed that 2 members of the currently 6-person committee actually voted for a 50 basis point cut. So that's a dramatic turnaround from May when 1 person in the committee voted against cutting at all. In addition to that, their forecast track for the official cash rate was dropped hugely by 30 points. So it now shows a 90% chance of a cut in October and a 90% chance of a cut in November. So at this point, you'd be brave to forecast anything else.
And we'll have more from Sharon in today's deep dive. Number 3, China kept its key 1- and 5-year loan prime rates on hold yesterday. ANZ senior China strategist Yao Pengxing says this was as expected.
We expect this July to September will be time window for the PBOC to watch. If the growth momentum deteriorates further, the PBOC will cut again. We maintain our call of 20 bips interest rate cut in the second half of this year.
Number 4, Bank Indonesia surprised markets with a back-to-back 25 basis point cut in its headline rate to 5% yesterday. ANZ economist Crystal Tan says the move came as the central bank raised its growth forecast.
So the decision and the policy messaging showed a stronger pro-growth bias. BI signaled it is on the lookout for scope to further lower rates to encourage even higher growth. Now, on the external front, BI appears comfortable with managing external risks, noting capital inflows and also rising expectations of US Fed cuts. So taken together, we see scope for 2 more rate cuts by Bank Indonesia this year, taking the policy rate to 4.5%.
Number 5, Taiwan's exports were up 15.2% in July from a year ago, boosted by demand from the US. Bansi says strong demand for semiconductors is keeping order books full.
We are expecting this strong momentum to continue, even if the growth rate cools somewhat. It's on back of this strong demand for tech goods that we are seeing Taiwan's GDP growth clock 8% in the second quarter of this year, and it is the reason why we're expecting growth in 2025 will be north of 6%.
Bansi Madhavani there. Now, in today's deep dive interview, ANZ New Zealand Chief Economist Sharon Zollner takes us through the Reserve Bank of New Zealand's latest forecasts after a cut and dovish turn yesterday.
So we've been noting for some time that the economy is not performing as expected. They made a comment in July that the level of activity was much as they had forecast back in May, which was a bit of a head fake, really, because it is true that in a level sense, but the economy was stronger than they thought at the start of the year, but a lot weaker than they thought in the most recent period. And surely it means something that the economy is pointing down when you think it should be pointing up. And as it turned out, that has been weighing heavily on their minds. They described the economy as having stalled. It's been a while wide range of data has suggested that. It's not across the board. The agriculture sector is doing very well, but construction, retail, hospitality, services, manufacturing, all of those sectors did stall somewhat in April, May, June. We haven't got that GDP data yet. We won't get that for a month, but it's clear there was widespread malaise. It's not entirely clear why. In terms of investment and that sort of thing, perhaps it's the global headwinds, the uncertainty there. Households, one suspects it's more to do with the cost of living, the fact that some necessities have gone up in price so much that it's just leaving less cash left over for the nice to haves. Plus, the labour market, we think, is softer than the headline unemployment rate would suggest. Measures of underemployment, for example, underutilisation of labour. And it's very hard to find a job if you've lost one at the moment. So all that seems to have weighed. The good news is the economy does seem to be improving. We and the Reserve Bank are forecasting the economy to grow in the second half of the year, but nothing flash to start with. But, glass half full, the Reserve Bank has backstopped that recovery. They've brought about a meaningful easing in monetary conditions. We saw interest rates and the exchange rate both drop sharply, and that will translate immediately through the economy and into the vibe. I mean, yes, it takes a year or more for it to feed through the economy in its fullest sense, but absolutely it can change the mood quite quickly. And this has come just in time for the usual spring lift in the housing market.
So we've had some debate about fiscal policy and monetary policy. Is this just monetary policy doing its job?
Yes, the Treasury came out at a piece of analysis saying that really cyclical stabilisation is monetary policy's job, and fiscal policy, because of the lags involved, and it quite often gets it wrong, and it's obviously quite expensive when it does. So this is a classic example of monetary policy stepping up to the plate in a way that we think is quite appropriate. We've been forecasting that the official cash rate needs to go to 2.5% since April. What we weren't expecting was that the Reserve Bank would come around to our view quite as quickly as they have in the end, and the market wasn't quite there either, and that's why we've seen quite a big market reaction on the day.
So inflation is still at the top of the Reserve Bank's target band. Is there any indication the bank is concerned about that?
So the Reserve Bank's been balancing a slightly awkward mix of upside inflation risks in the near term, but downside risks to inflation in the medium term from the fact that the activity's not been all it was cut out to be. It's pretty clear today that they are focusing now very much on those downside risks. They mentioned the upside risks in passing, but because they now think there is more spare capacity in the economy than they thought, that the economy is weaker, the risk of those one-off impacts on inflation becoming persistent and feeding into pricing decisions in the long haul, that risk seems negligible at the moment. So that's certainly our view. Our business survey suggests that firms are finding it very, very difficult to pass cost increases through into their prices, and it's hard to see that changing anytime soon. Wage growth is also very benign. Yes, some measures of inflation expectations are elevated, but it's not the sort of environment where that is going to feed through to self-fulfilling inflation. But the Reserve Bank did actually revise up their forecast of near-term inflation. They're now seeing it hit the 3% top of their target band. That's a little awkward optically, but the Reserve Bank targets medium-term inflation, not inflation in the next 3 months, because that's a bygone.
So what did they say in these new forecasts about where the economy heads over the next year?
So in terms of growth, they see the economy as having shrunk 0.3% in the second quarter. We've been talking about downside risks to our forecast of plus 0.1 growth for a while. So there's a growing consensus that the economy did actually go backwards in that second quarter. They're then forecasting it to grow 0.3% in the third quarter. But if you look at it, that's basically the economy going sideways for 6 months. The growth gets a little bit more meaningful after that. And that's a very similar trajectory to what we have in our forecast, which of course our forecasts have had extra cuts in there. And that is a big part of the story of why the economy gets its mojo back.
Sharon Zollner there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, August the 21st. Catch you tomorrow with analysis of the FOMC's latest meeting minutes ahead of Chair Powell's Jackson Hole speech on Friday night. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.